Does the stock market feel like an unpredictable roller coaster to you? One day you're up. The next, you're screaming down faster than you can say, diversification. Fear not. Because today we're talking about a strategy that might just calm those market jitters, dollar cost averaging, or as the cool kids call it, DCA. What is DCA, and why do so many financial experts recommend it? Stick around, and by the end of this video, you'll not only understand dollar cost averaging, but you'll also know how to use it wisely, and maybe even sound smarter at your next dinner party. What is dollar cost averaging? Investing a fixed amount of money at regular intervals, regardless of market conditions. Think of it like buying pizza every Friday. Sometimes there's a discount, market is down. Sometimes there isn't, market is up. But you're always getting a slice of the pie. Say you invest $100 in an index fund every month. When the price is high, you buy fewer shares. When it's low, you buy more. Over time, this smooths out your cost per share. Pros of dollar cost. Averaging reduces emotional investing. No more trying to time the market, which, let's face it, is harder than predicting who wins the next season of The Bachelor. Mitigates risk. By spreading your investments, you're less likely to buy at the absolute peak or sell in a panic at the bottom. Consistency is key. DCA works like a gym membership for your financial health. Regularity builds long-term strength. Great for beginners. If you're just starting out, it's a no-brainer way to dip your toes in without worrying about perfect timing. Cons of dollar cost averaging not optimal in a bull market. When the market consistently goes up, investing all at once could actually make you more money. But hey, who has a crystal ball? Transaction fees. If you're paying per transaction, small and frequent purchases can eat into your returns, like buying $1 coffee but paying a $3 delivery fee. No bueno. Doesn't guarantee profit. Let's be real. If you're investing in bad assets, no strategy can save you. It's like trying to DCA into a failing company. Ouch. How to use dollar cost. Averaging, choose an amount. Start with an amount you can comfortably invest each month. Hint, don't skip your rent to buy Tesla shares. Set a schedule. Monthly or bi-weekly investments work well. Tie it to payday for an automatic reminder. Pick a platform. Many platforms let you automate investments. Set it and forget it. Focus on diversification. Stick to broad-based ETFs or mutual funds. Don't DCA into a single meme stock. Your future self will thank you. Examples, scenarios. The bull market believer, Jane invests $10,000 all at once in a bull market. She ends up making more than Joe, who used DCA. Lesson: DCA isn't always king, but it's safer. The nervous newbie, Joe uses DCA and invests $500 monthly into an index fund during a volatile market. Over time, his average cost per share smooths out and he sleeps better at night. The transaction fee victim, Sarah buys individual stocks using DCA but gets hit with $10 fees per trade. Her gains get eaten by costs. Automate and go fee-free where possible. Dollar cost averaging is a solid strategy for consistent, disciplined investing. It's not flashy, but hey, neither is flossing, and we all know how important that is. Have you tried dollar cost averaging? Share your thoughts, or better yet, your success stories, in the comments below. And remember, whether it's DCA or lump sum investing, the best strategy is the one you stick with. Start small, stay consistent, and let the magic of compounding do its thing. Thanks for watching, folks. If you found this helpful, hit that like button, subscribe, and share with a friend who could use some financial bumper lanes. It will help us create more fun and helpful videos like this. See you next time.